And now for something completely different.
It's a rich man's world.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
So welcome to the Monday edition of the Real Investment Show. I'm your host, Lance Roberts, and of course, Brent Clanton joining me this morning. And as we get ready to run up into Christmas, yeah, it's that time of the year. My wife reminded me last night that shipping is going to be slowed up this year because there's such a demand for people buying stuff online that you better get your stuff ordered now if you want it shipped. And that was basically her hint that her Amazon list is now full. So I will be braving the crowds of going online to Amazon and ordering her Christmas gifts today.
You are indeed a prescient and wise man.
Exactly. Speaking of Christmas, right? Survey out. Now, and you wonder, right, how many people are Grinches, right? How many people are Grinches about Christmas? Survey out this morning talking about when is it appropriate to start playing Christmas music?
Oh.
Yeah. About 6% of the people, about 9% of the people say all year long. Those are your optimists, those are your people that you don't like being around because they're always just happy and chipper, right? About 85% of Americans say either right after Thanksgiving or as soon as December starts, right? You can start playing Christmas music. 6% of the people polled, never. It is never appropriate to play Christmas music ever. Those are your Grinches. So we know that 6% of the population roughly, never play Christmas music. Anyway, it is that time of year. Christmas music is out. Interesting story out over the weekend. HBO has now decided that they are going to release simultaneously all of their movies in 2021 at the same time that they release them to theaters. Now, this is interesting, right? Because theaters are one of those areas that are being really challenged in order to make, basically trying to get movies out and get revenue going, etc. This is one of those big challenges that they've had. And of course, as we began to really start to get into 2021, the thought is, hey, we get a vaccine, we're going to get people back out into the world, people will start going to the theater again. Well, this is going to be kind of the new challenge here as HBO says, hey, you know what? We're just going to release everything to on demand. Just the minute we release it out to the studios, they'll go straight to on demand as well. So again, is this really kind of the beginning of the end of movie theaters? I think not. One thing about movie theaters it's always been kind of a date night type situation, right? Hey, let's get out of the house. Let's go to dinner. Let's go see a movie, whatever it is. And it's been a way for people to get out of the house and do other things. So, despite the headline saying, telling you that it's the death of the movie theater industry, this certainly doesn't bode well if all these, kind of producers of movies start to do this, kind of take the same tack and releasing it simultaneously. The reality is I don't think that occurs. Even HBO said we're just going to do this next year, and then we may go back to doing it the way it was right after that. We just need to do something to get our movies out and start making some money. They spend a lot of money making these movies, and of course, a lot of these big franchises, these big blockbusters, haven't really been able to get out there. And they spent, for instance, Black Widow, which is the ongoing consensus of the kind of the Marvel universe, right? That's been one of those kind of movies that's been just sitting on the shelf now. They spent a lot of money building that. And the way they really make that revenue is not releasing it to on demand. It's by people going to the theaters. So most likely what we'll see is that, as we do get a vaccine and people do get comfortable to get back out into the world and actually start doing things, we'll return to some normalcy and the movie production industry will go back to where it is. But it was an interesting headline from HBO about what they're going to do next year by starting to release their movies directly. Okay, let's get to the markets here real quick. Last week was a very good week again, just kind of this ongoing kind of bullish sentiment of the markets. I mean, everybody's just so excited. The reality is that if we take a look at a lot of our indicators and a lot of our sentiment indicators in particular, what we're seeing is a tremendous amount of optimism in the markets. In fact, if we look at put-call ratios, we look at a lot of the measures of sentiment. Even the city euphoria index is at now deep into euphoria territory. This is one of those points in time where markets are really, really well far ahead of the actual underlying fundamentals. And again, as we've been talking about, though, this little rally we've had here last week wasn't really surprising. We did turn the money flow indicator back up here. But the important thing here is as we talk about this, that money flow indicator is now back to where normal peaks of markets have been. And again, this is where we have kind of really pushed this. So not surprisingly, what we'll probably see here in the next couple of days is a little bit of relaxation here. And again, as we we're still in the midst of distribution season now, hasn't really seemed that those distributions haven't overwhelmed the optimism of the market yet. We're still in that period. So it's very likely we're going to see a little bit of a relaxation here. Doesn't mean we have to have a major correction. Haven't been saying that at all. But we do have the setup here for a 3 to 5% pullback. It's very easy to get there without much of a stretch for the markets here because we're so deviated from longer term means at this point that a bigger correction is likely at some point. That could be after the year, after we get to the end of the year and into January. We may see it then. But again, just kind of watch this money flow indicator here because once we see that begin to turn down, that's going to be your indication that you're probably likely going to get a little bit better kind of risk avoidance at that point, shall we say. The other side to keep a watch on, of course, is continues to be fixed income because if we take a look at what's happening with bonds, bonds have been pushing back down here towards lows. Yields are back up towards 1%. Now, the important thing about that is that yields are a function of what happens economically. And as yields begin to push back up into this 1% territory, that seems a little bit ironic, right? A whole 1%. But that's enough now because of all of the debt and deficits that we've piled on here over the course of the last really decade. Even small increases in yields have an impact on the economy, begins to slow things like mortgage applications and other things, especially anything debt related like consumer credit, etc. Small changes to interest rates change buying habits because it raises the payments. And again, a lot of people are buying things because of low interest rates, right? An interesting story of the weekend on CNBC.com talking about a young lady. She makes $95,000 a year and she just bought a $300,000 house. She put 1.8% down on the house. Right. And so this is the point, is that the only way that you can afford that house on that kind of salary potentially is to get your payments low enough and have a low enough down payment to get into it. The problem with that is that she has another whole bunch of debt, about $79,000 worth of debt outside the mortgage. And of course, trying to make all these payments, make ends meet, then of course, paying taxes and upkeep, et cetera, on the house. Well, that all becomes a potential burden. And so when small changes happen, and interest rates pick back up, well, all of a sudden those payments begin to outpace what people can afford. Also, there's a psychological impact of that is if mortgage rates do tick up, people go, you know what, I'm just going to wait and see if rates come back down again, and then I'll go buy my house, right? So people also have, same thing for cars, same thing for autos. When rates tick up, people go, you know what, I'm just going to wait to see if that rate comes back down again so I can get it cheaper. Because that's what we've taught people now over the last decade is that rates always get cheaper. So if you just wait, you're going to get a cheaper rate down the road. And it's really been the habit here. But again, this has a real implication here short term because if we begin to get that contraction, we're going to start to see the economy slow down. And of course, that's going to push more money into safety, which is kind of the risk off bet from the market. So particularly if we get a risk off event in the markets, in other words, the markets do begin a more interesting correction at this point, we're going to see money flow into safety of bonds, and we'll start to see yields come back down again. Stock prices will come down and probably eventually even see a pickup in the dollar, because one of the things that we've been talking about here over the last couple of weeks is this very, very deeply depressed area on the dollar, and we're actually starting to see it tick up here. So pay attention to that. Be right back after the break. Got a lot of stuff to get into this morning. Why the markets are like sex. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
This is Lance Roberts, your host, wishing you all of the best in the new year from all of us at RIA Advisors.
This is Nikki Brock-Moreska with the RIA Advisors HR Department, wishing you and your family a very Merry Christmas.
Hi, this is Craig Severin, Senior Financial Planner, wishing you a Merry Christmas and a Happy New Year.
This is Brent Clanton, Executive Producer, wishing you all the best in the new year.
Hi, this is Connie Mack, CEO, wishing you and your family a Merry Christmas from all of us at RIA Advisors.
You're listening to The Real Investment Show.
So welcome back to the show this morning. I'm your host, Lance Roberts. It is, of course, Monday as we get this new week underway. On the website, of course, our newsletter is out. And what's interesting is that, you know, over the last couple of weeks in particular, this has been, and we've seen this several times this year, and it's always amazing that, you know, you typically start getting the same type of emails and things about this time. Every time. We saw this back in September. We saw it again in October. Hey, this market this market just keeps going up. It's just not ever going to correct. And that's generally about the time that you generally get a correction. And particularly when you start to see things, as we discussed over the last 2 weeks, really in the newsletter, which is this kind of exuberant optimism of the markets. Again, just virtually every measure. And actually, the more speculative the measure, like, for instance, stock options, the put-call ratios, the call volumes, you know, option trading is the most speculative form of trading because contracts expire worthless. It is a pure bet on price because options contracts have both a limited duration, they expire, and they are a leverage on investment. So in other words, I can spend a little bit of money to buy a larger position in the company, but the risk is that if the price goes against me, my option goes to zero. I mean, that's just the reality of options. So it's a very speculative form of investment. They have a lot of opportunities, and of course, they can be used to hedge risk. Absolutely. I'm not saying that at all. But when people are just simply buying them for the purpose of trying to leverage their investment bet on the markets, then you begin to see this type of a kind of this idea of risk and exuberance. And Warren Buffett once said, he said, the markets are like sex. They feel best right at the end. And that's really a true statement. And when you start getting emails and things like this, is like, hey, Lance, last week you talked about a potential correction, but it hasn't happened yet. So is it not going to happen? Yeah, it's going to happen, but it's, you know, things kind of take their time, right? So, you know, when these things continue to get more and more exuberant, we continue to leverage up more and more, it's going to lead to an eventual reversion of price. And that's just a function of math, right? I mean, it's not, you know, markets cannot simply just go up because you've got to ultimately have buyers and sellers that, you know, that dictate price action. And at some point, buyers will become exhausted and you'll have a correction because sellers will begin to sell more. So, you know, this is just a function of how markets work over time. It's not rocket science. It's not being bearish. It's not being anything else. It's just understanding that, you know, at that, you know, peak moment when you are most exuberant, right? That's generally closer to the end of the rally than the beginning. And it doesn't mean you're going to have a big bear market. This is also the misunderstanding is like, you know, you're talking about a correction, you know, how big is it? 30%? No, you know, we're talking about, you know, 2, 3, 4, 5, you know, maybe 10%. You know, you know, these are very normal corrections with any given market year. We've had 2 10% corrections, one in September, one in October, right? We had 35% correction in March. That was kind of outside norms. But again, those have all happened in this year, just this year, right? So these corrections from these more exuberant levels are something that just happen on a regular basis, and you have a couple of choices. You can certainly just write it out, right? You can just, you kind of write it up, write it down, write it back up again. But, you know, don't forget that, you know, getting back to even, you're not really kind of making any money. So this is when we talk about, you know, hey, take some profits. You know, when markets are exceedingly exuberant, go in and trim off some profits, things that have gotten, out of tolerance within your portfolio. What does that mean? Well, let's say that normally when you buy a position, you buy, 3% of your portfolio into a position. So now it's grown to be 5% of your portfolio. Okay, we'll trim it back to 3, right? You still have your original position. You've taken some money off the table. You've got that in cash. So now you've got an opportunity that when you do get a correction, you can either buy those shares back again at a lower price, or you can buy something else on sale, right? And this is kind of the whole point of money management, which is, the basic law of investment is to buy low and sell high. But if you don't ever sell high, you have no capital to buy low. So you just kind of wind up riding the markets up and down. And that's okay. Again, that's completely fine if that's your choice. And normally it doesn't hurt you too much, right? You go up, you go down 5%, then you go back up to where you were, and so forth and so on. The what gets you ultimately is when you're buying and holding and you have a 40-50% decline, right? And then you spend a bunch of time getting back to even. This year was very much an anomaly because markets corrected by 35%. We should have gone lower based on what valuations were at the time. But because of actions by the Fed and a lot of exuberance of the markets, markets have run back up in some of the most speculative areas, right? And so we're back to all-time highs in the same year you had a correction. That's very rare that type of thing happens, but we did. We just had a correction. We didn't have a bear market. And we talked about this before. A correction is a decline in the market that does not break the trend, and you quickly recover back to all-time highs. Exactly what happened this year. The 35% correction in March just simply came back down to our trend level of the markets going back to 2009. We didn't establish new lower levels. We didn't do anything. We quickly recovered back to new highs. So March was just a correction within an ongoing bull market that started back in 2009. When you get a bear market, it will be something more protracted. You will break the long-term trends, and prices will take a longer time to recover, generally 3 to 5 years to get back to even. Given the extension of the market above long-term means, that correction is going to be large eventually, 50, 60%. That'll happen at some point. Now, I don't know when that'll happen. I'm not saying it's going to happen tomorrow. Not going to say it's going to happen in 5 years. Could be a decade from now. Who knows? But the point is that at some point, you're going to have a issue where markets revert back to some type of normal valuation level, right? You're going to get an undervaluation of the market versus an overvaluation of the market, which is where we are now. Look, as an example, right now, the global market capitalization rate. Now, what does that mean? Market capitalization is the price of all the stocks that are traded versus the number of shares that are available for people to buy. Okay? That's market capitalization. How much are you paying for all the shares? If you could buy all the shares of every company in the world, for about $100 trillion, you could buy them, right? And you would literally own every company that's publicly traded on the planet. That is global market capitalization. Now, what these shares should represent is the global production of goods and services that all these companies produce, okay? The revenue. Right now, as we speak, the market capitalization is greater than all the goods and services that these companies produce globally on an annual basis. So in other words, if you had the left pocket change of $100 trillion to go buy all these companies, you would spend more buying all the shares of these companies than the total value of the economic growth of the entire planet. Now, does that sound like a good deal? So at some point, when you have that kind of exuberance in the markets, at some point, you have to revert those valuations, right? And that's just a function of time and economics, and it's also just a function of how markets work over time. So, it's always very easy to get into this exuberance, right? Like Warren Buffett said, sex feels the best right at the peak.
And that's kind of where markets are. Right now, it feels great. There's absolutely, doesn't seem like anything can go wrong. It doesn't matter what people say. Markets just keep going up. And it's all based on hopes of more vaccine, a vaccine. Pfizer talking about maybe they're going to get the gold standard FDA approval just any day now. And may have some of the first vaccine shipments out, by the 15th of December. Pretty cool, right? Only problem is that you've got 300 million Americans to vaccinate, and they're going to get about 1/10 of that out in December. So it's going to take some time to get vaccinations done. It's also a dual vaccination. So to vaccinate 300 million people in the U.S., you need 600 million doses. That's not even talking about the UK and other places around the world that have to get vaccinated. This is going to take time. Got the government talking about doing more stimulus. Great. More checks to households maybe. Not really in the bill they're talking about now, but, that's something they all want to do. More unemployment benefits for 4 or 5 months. That's fine. More debt, more deficits. But, you get some more checks out there. So, again, that is good economically because it pulls forward future consumption. But the problem is that what are you going to do after that? Right? So now we got everybody vaccinated. We got everybody some money in their pockets. They pull forward future consumption. Now what? You still got to get people back to work ultimately. And you still got to get people earning money. But now we've changed the dynamics of how we work within the economy. Employment rate on Friday slowed down rather dramatically, right? We only had about 247,000 people employed. So it was a good number. We're getting back to normal now. That's about the normal. Between 180 and about 220,000 a month, that's about normal of what we hire to support population growth. So again, we're going to return back to normal. The problem is the new normal is going to be slower than the old new normal that we had over the last decade, but yet now markets are valued more than at any other point in history. So again, it's just a function of math ultimately, but just remember that eventually things have to return back to, what you would expect to be a fair valuation. Be right back after the break.
Listen anyplace, anytime at realinvestmentadvice.com.
Ho, ho, ho. Merry Christmas. No, it's not Santa. It's Rich Rosso, Director of Financial Planning for RIA Advisors.
Hi, this is Samantha, your Senior Client Service Administrator.
This is Chris LaRochelle, Senior Advisor with RIA Advisors in Round Rock.
Hello, season's greetings. This is Diana Williams, Client Service Administrator at RIA Advisors.
Wishing you a very Merry Christmas and a Happy New Year.
The Real Investment Show.
And welcome back to the show this morning. It is 6:33 as we get this morning underway. So just on the break, Brent and I were talking about our favorite Christmas movies, right? So just, talking about it's that time of the year, time for all the Christmas movies that are coming out. And every year it's always like TNT or TBS, somebody will run like the Christmas Story, nonstop for like 24 hours, right? Mm-hmm. I'm going to start my own Christmas channel. Which plays the only there is only one true Christmas movie every year that you should watch. And that's Die Hard with Bruce Willis.
And there's a trilogy of them, so
exactly
you never run out of content.
But there should be a 24-hour series of Die Hard for Christmas.
The Die Hard channel.
I can't get my wife into it, but every year it's like, honey, Christmas movies are. She's like, let's watch The Holiday. I'm like, no, it's Die Hard. She's like, again. Put on your hat. Anyway,
it's just not Christmas until the guy gets kicked off the top of that tower.
Exactly. Then Christmas is here.
Yeah.
So, we were talking a little bit about, one of the things that's really been driving the markets here as of late, of course, is hope for a new vaccine. We're going to get this vaccine out and everybody's going to get vaccinated. And interestingly enough, there's a movement afoot to make sure that you have a vaccination card. And, there's talks about it'll be like a driver's license potentially, and, it'll be registered with the government that you've had your vaccination. Companies are making movements. There was an article out over the weekend that companies are thinking about requiring you to be vaccinated to come back to work or to get a job. Sounds great. Except for the fact it's a little bit communistic. Show me your papers. You cannot come in this store without your papers. This is kind of the idea. I mean, the rush here, to get people vaccinated. Hey, I get it, right? I get it. They were talking about over the weekend, though, is that if you are pregnant or thinking about getting pregnant, don't take the vaccine. Because they haven't tested. They don't know. This vaccine has not been tested, right? They've tested it for the function of, can it actually, keep you from getting the virus? Yes. That's, they think they have about a 95% efficacy of this vaccine. Takes 2 injections, 21 days apart. And hopefully that if you take that, you won't get the virus until it mutates. That's the other problem. But what they haven't tested it for, because they haven't had time, is side effects. You don't have to go very far to watch a drug commercial on television, right? I love the ones, in particular, I love the ones for depression drugs, right? We are all depressed now, so we all have to take drugs to cure our depression. How about get out of the house and go exercise a little bit? It does wonders for your depression, right? But we all got to take a drug for depression. We're all depressed now, so we all got to take a drug for depression. Listen to the commercial, because it says this drug will cure you of your depression. You're going to feel better. You're going to want to go hang out with friends. By the way, you may, have bleeding gums and, wind up with, cancer, heart attack, a whole variety of other terrible things, but you won't be depressed. You'll be on your deathbed, but you'll be happy about it because you won't be depressed.
The possible side effects should drive you over the edge anyway.
Exactly. But that's the risk here with the vaccine. We have no idea about what the side effects of the vaccine is. And in fact, the side effects of the vaccine, considering that the death rate of the virus is 0.0005%, the survivability of the vaccine is 99.5% roughly. So it's a very, very small potential rate of death from the vaccine. And the point is that because we haven't had time to test the vaccine in terms of what the potential side effects are, the side effects could be worse than the disease itself. That's the risk, right? And so, in our haste to go out and try to get everybody vaccinated and get everybody an ID card, there is another risk that we're not paying attention to, which is the side effect risk of these drugs. And again, this is all fine and dandy until the virus mutates and, then the drug's ineffective. And it's like you go get the flu shot every year. There's about 150 different strains of the flu. The flu vaccine covers 5. And this is why even if you get the flu vaccine, you still get the flu sometimes. Okay? Happens. But this is where we are, right? We're in such a panic and such a rush to do this that we're potentially putting more people at risk than we are actually with the virus, right? And same thing goes with debts and deficits. We're in such a rush to get stimulus out that we're not looking at the consequences of those actions. Right now we're running a record level of debts, record level of deficits in the U.S., which have a direct impact on economic growth, right? Economists can't figure this out. It's like, hey, debts don't have a cost. Yes, they do. When you're recycling tax dollars, it slows economic growth. When you incent people not to produce by giving them money, you slow economic growth. There is a consequence. There's a cost. There's no free lunch for anything that we do. And in the rush to do things, we overlook the risk of those actions and say, well, this is what we've got to do. And if you listen to the kind of our people in Congress right now, they're like, oh, we got to get more stimulus out, right? The economy's just on the verge of crashing. We just hired, 250,000 people on Friday, right? But we got to get this money out. We got to get taxpayers to pay in more money into the economy, right? More debts, more deficits. But we do this without really an understanding of how the money gets out there, where it goes, and we have really no control over it. Let me give you some examples. This is a study that just came out from a government watchdog. 20 large federal agencies have admitted to dispersing $2.25 trillion. $2.25 trillion. Now, that's a lot of money. They have admitted to dispersing an astonishing $2.25 trillion in improper payments. Last year, these improper payments totaled a total of $175 billion. That's about $15 billion a month, $500 million per day, and about $1 million a minute in improper payments. Where'd those payments go to? $175 billion in estimated improper payments were reported by the 20 largest federal agencies, averaging $14.6 billion per month. And this was from 2004 to 2019, totaling $2.25 trillion. Where to go? The worst program, not surprisingly, Medicare, Medicaid, and the Earned Income Tax Credit. These are people basically committing fraud into the system. And this shouldn't be too hard, right? Medicare, Medicaid. When do you get Medicare, Medicaid payments? When you're over 65 and you're still living. Now, we have ID cards. We've got Social Security numbers. We've filed tax returns. It's pretty easy to figure out exactly what your age is and what your requirements are. Shouldn't be too difficult. Little bit of work here, folks. We could save a good bit of money, but yet weird. You can't make this stuff up. $871 million in mistaken payments were made to dead people. Medicare, Social Security payments, federal retirement annuity, pension payouts, and even farm subsidies were sent to dead recipients. The root cause was failure to verify death. For your total, $2.8 billion. The problem is that we have 6 million Social Security numbers active for people over the age of 112. Let me say that again. We have 6 million Social Security numbers active for people over the age of 112. Problem is, there's only 40 people in the whole world that are above the age of 112. That's the whole world, right? And I would venture to guess that those 40 people probably live in China because they live forever. The worst ever trend, of course, Medicare, Medicaid, and proper payments soared from $64 billion in 2012 to $88.6 billion in 2017. In 2019, it's already up to $103.6 billion in improper Medicare, Medicaid pay. Again, this isn't hard. You have the Social Security number. Did the person file a tax return last year? Yes. Send them a payment. They didn't file a tax return last year, probably dead. Don't send them a payment. This isn't difficult. Best turnaround, actually, was in the education department. They overpaid $6 billion to college students that were receiving Pell Grants. In 2019, they reversed that. They only overpaid them by $1.1 billion. Good job at turning things around. We're going to get there. Purchasing power, what can $175 billion buy last year? A whole lot. This is the issue. We're talking about doing another $500 billion to $900 billion, and we're blowing that much out the window in improper payments. Look, PPP loans alone, billions of dollars in PPP loans that went to fraudulent enterprises. People were signing up for unemployment checks that weren't even unemployed. We have no way to verify these what they call these public unemployment assistance checks, which are for people that claim to be self-employed. There's no way to verify that employment. We are just literally throwing money out the window and having no idea where it goes and just hoping that somehow it winds up in the right place. Be right back after the break.
So follow me, that's life.
You're listening to The Real Investment Show.
Hi, this is Danny Ratliff, Senior Financial Advisor, wishing you and your family the merriest Christmas from all of us at RIA Advisors.
This is Nick Lane, Analyst for RIA Advisors.
This is John, Senior Relationship Manager, wishing you and your family a very safe and Merry Christmas.
This is John Levy, Senior Advisor for RIA Advisors Austin and President of Advanced Wealth Strategies Group in Round Rock, Texas. I'd like to wish you all a very merry and blessed Christmas and holiday season. God bless you.
The Real Investment Show.
I am slowly witnessing the death of the world as we know it. I was just getting ready for this segment and clicked on an article I wish I wouldn't have clicked on now. Kazakh bodybuilder marries sex doll girlfriend.
Oh, I saw that. Yeah.
Saw this?
Yeah.
Okay. There's one basic basic fact to human survival, which is procreation. So if let's start a trend where everybody just marries sex dolls and we can pretty much solve our population issue within 2 generations.
It's Darwinism at its finest.
Exactly. Let's get back to the real world here. I want to talk a little something about loan forgiveness. Headline out this morning: as Democrats push loan forgiveness, data shows that blue states have the highest average debt, and this is true. There's a difference in philosophy between liberals and conservatives about money. Most red states run a fairly balanced budget. They tend to be more profitable. Can't understand why everybody's moving from California, New York to Texas. I keep telling you people, and you won't listen to me. You need to put the border on the north side of Texas, not the south side. Because once, what's interesting to me about this is that, Elon Musk and Tesla and Hewlett Packard, all coming to Texas, right? Great state for business, no income tax. You pay. There is an income tax, by the way. This whole idea that we don't have a state income tax is complete hogwash because you pay for it in property taxes.
Oh yeah,
but we don't have a state income tax, so they're all coming here, and this is what I don't understand. They come here because of the great benefits that the great state of Texas has: no state income tax, freedom to own guns,
75-mile-per-hour speed limits.
Beautiful women. We have the most beautiful women anywhere in the world.
And we have Tex-Mex.
And we have Tex-Mex. And we have best barbecue.
Oh, yeah.
I don't care where you go. People are this is like St. Louis barbecues. No. That's Texas barbecue.
It's not even the same.
But the point is they all come here. Then they vote for the same policies they left. And so eventually Texas will become California. It's just a function of time. Because we're slowly heading that direction, and last election should tell you that we're headed in that direction. Anyway, but here's the point. So all these states that are pretty much liberally run have huge debts and deficits. This is the whole point right now about what's happening with one of the hangups that we've had on getting another stimulus bill passed was support for state municipalities. A lot of these blue states are deeply, deeply, deeply in the red, on the verge of bankruptcy because of the coronavirus. They've had a big slowdown in revenues, and they can't service their debt, and they've got lots of problems. So, right, we've got to get them a bailout. We don't need to bail them out. They have access to public markets. They can go raise more debt. Okay. But the idea now is hey, let's just forgive the debt, right? Student loan debt. Let's just forgive it. Let's just talk about student loan debt for a second, right? Just because we can isolate it to just one type of debt for the conversation purposes, but this actually applies to all debt. So in 2008, when Barack Obama took over as president, he shifted student loan debt from the private sector to the public sector. In other words, the government took over student loan debt. Well, of course, as soon as that happened, colleges went, hey, you know what? Government's giving out loans. They'll give them to anybody. Let's jack up the premiums, right? So college tuition took off. And the higher that college tuition went, the more the government gave out loans to people who really couldn't afford them. So used to, when you went to go get a student loan, it was very specific and you had to qualify for it. So after decades of people applying for student loans, up to 2008, there was only about $500 billion in student loans out over decades, right, that people had taken out. College tuition costs had gone up on an annual basis, kind of on inflation-adjusted terms, but because there wasn't this mass deluge of debt, college tuition was pretty reasonable. You could afford to go to college. Well, after Barack Obama took over, says, oh, everybody needs to go to college. Here, we're going to take over student loan debt. Well, student loan debt exploded in a couple of years. We were at $1 trillion of student loan debt, and college tuition had skyrocketed. Same thing with the Affordable Care Act, right? He says, hey, we got to get everybody health care, so we do the Affordable Care Act, and we're going to put people with pre-existing conditions into the existing condition pool, and boom, we blow out premiums, and you can't afford health care anymore. This is the problem whenever you get government involved in a program. It all sounds great. You know, these liberal ideas all sound great in nature. Everybody needs health care. Everybody needs to go to college. You create problems. So now we've got to figure out we got ourselves into this mess. Now we go, well, okay, well, now let's just forgive the debt, right? Okay, so here's a couple problems with forgiving debt. First of all, somebody owns that debt, not the government. The government issues the debt. Somebody bought it, right? There is a lender on some side of that student loan debt. So when you forgive debt, the government has to make whole that debt to somebody else. So Brent here's the example. Brent goes and gets a student loan from the government, $100,000. Government says, okay, Brent, we're going to pay off your student loan. I'm over here. I'm actually owning, because I bought the treasuries or I bought the student loan debt. I own the debt for my clients, right? We're depending on two things: the interest income on that debt plus the principal repayment of the bond. Now, this applies to everything, right? So this is student loans, this is treasuries, this is, you name it, Fannie Mae, Freddie Mac, any debt. This applies to all debt. In all debt, there is the person that took out the loan and there is the person that put up the money. And when we're talking about government debt, who's that person that put up the money? Taxpayers. Now, here's the irony of this. Let's forgive Brent's student loan. Okay. I've got to pay back the person with the government. I've got to pay back the person that put up the money to start with. So the government has to do what? Issue more debt in order to have the money to pay off the other debt. So it doesn't change the debt dynamics. We talk about a debt jubilee. We're just going to write off the debt. No, you got to pay the people. If you don't pay the people that have the debt, they won't loan you any more money. Ever. They have a real, people are real, kind of persnickety about losing money. And as soon as you decide that you're just going to wipe out the debt, you have all kinds of other problems. But the point is this doesn't solve the problem, because here's the other problem with this. Okay, great. So we've got all these people out here that paid off their loans. What about those people that worked for years, paid off their student loans? What do they get? They get a refund? But more importantly, let's pay off. Fine. Let's pay off Brent's student loan. Okay, so now let's just wipe out all the student loan debt. So there's $1.5 trillion, about $1.4 trillion worth of student loan debt. Let's just wipe it all out. Nobody has student loan debt. Okay, what about the next person that wants to go to college? He's now expecting his student loan to be forgiven by the government. And the person after that. And the person after that. And the person after that. So eventually you wind up bankrupting the whole college system, or you drive the cost up so much that even the government can't afford at that point, because there's no free lunch. You cannot have a free college system, because that has to be supported by the government. And as soon as the government says, guess what? College is now free. Two consequences happen of that. First of all, you got to support that system, right? The teachers have to get paid. The facilities have to be maintained. Electricity's got to be paid. Water's got to be paid. All that's got to, there's got to be income coming from somewhere. So the government's going to take all that over. So now we're going to have to issue out more debt in order to sustain the colleges. And of course, as soon as the government starts sustaining the colleges say, well, my salary for my professor last year was $100,000. That's going to be $250,000 this year. I'm still going to pay the professor $100,000, but the college is going to take the difference. Okay? So all the costs, this is just like the Affordable Care Act. As soon as you do this, the cost will skyrocket in terms of what the government has to pay. Just a function of how it works. $300 hammers for spaceships, right? Just the way, as soon as government gets involved, cost will go up. Why? Because there's no oversight of how the money's spent. I just went through the fact that we have trillions of dollars getting wasted on fraudulent payments. It's even worse if you look at the overpayments that we've made for government contracts over the past few years. The other problem with this is that let's give everybody free college. Hell, let's just give everybody a college degree. Let's make this really simple. Nobody actually has to go to college. As soon as you graduate high school, we're going to give you a college degree. Okay? Everybody now has a college degree. Guess what the value of that college degree is? Exactly the same as the value of a high school diploma today. Back in the 30s, 40s, people didn't have high school diplomas. Most of them dropped out in the 8th grade. They went to work on the family farm, right? Once we required everybody to get a high school diploma, you had to have a college degree to have that edge. Once you give everybody a college degree, now you're going to have a master's degree to have the edge. Supply and demand. If everybody has a college degree, then there is nothing that separates you from the other person out there, which means that the degree ultimately has less value, but it's costing us a whole lot more to get there. Wrap up the show for the day. I'm your host, Lance Roberts. RealInvestmentAdvice.com. That is RealInvestmentAdvice.com. Our latest newsletter is out, and our blog post is out right now. Why this isn't the next 1920 rally. It's on the website now, RealInvestmentAdvice.com. Have a great day. We'll see you tomorrow.
Get daily investment news you can use, delivered at the speed of the internet. Sign up for the Real Investment Report now at RealInvestmentAdvice.com.
It's a rich man's world.